I'm all right, thank you.
Yes. How is your studies going now?
Studies are going good.
Yes, now you must start writing your answers.
This is one area I really need a lot of
Yeah, I
a
know.
lot more
Lot of motivation, lot of thing, because that's the ultimate key for success.
yes, consolidation especially.
Yes, yes. So today we are going to look at consolidation, the subject, because the mock what I have put out is all about disposal of a subsidiary. So before we talk about the disposal of a subsidiary, we must know what is a subsidiary.
Yeah.
So I want to take you to a little bit of slides to get to this area of consolidation, because you remember your F2 area is basically bulk is consolidation, and today we are going to look at some of these areas.
Okay.
Right. So the mark that I put up for you is this film that was they were doing some one night, then summer night or something is going to a crisis. There are a lot of press articles, all that, and they are now thinking of disposing that film because the film is owned by a subsidiary company which is financed 60%, 40% kind of a thing, and if they can get rid of their interest, then they can dispose the subsidiary. So remember, this was the financial statements that they provided was consolidated financial statements. That means it has many many subsidiaries. So what is a subsidiary? What is a subsidiary and what is consolidation? That's our number one question. Right? So remember,
subsidiary is the
yeah,
carry on.
yeah. Yeah, basically, if you really look at a company, company is owned by shareholders. You and I, we can become shareholders of a company, and that company, we are the owners. The directors are the people who are managing the company.
Could you hold 2 seconds?
Yeah,
please?
sure,
Sorry.
sure.
Hi, Justina. Yes, sir. Okay. Okay. CC booking. Yeah, just have to explain them. They have given the car details to the online on the to the central reservations, but when we check them in, we have to take the payment. They have given the car details. We understand that, but they have not been paid. So when they gave the car details, what Travelodge, we reserved the rooms for them. We didn't buy them. We need to explain. They don't. Yeah. I can. Okay. I can. So who is she? Is she from? Is she third party or what? Business. Again? Was it the same woman, the Sarah? Huh. Okay. Is the party here? Okay. So how many rooms have they got? 2 rooms. That's all. Yeah. So you just. Yeah. So just explain. Well, if you want, I can ring them. But really, it's not gonna make. If you want, just pass me the number. Send me the number. Then I'll ring them. Just for future reference, try and resolve it with you and explain them with confidence. So if you think, if they can get the number of a manager out of you, that means they think they're gonna try it hard with me now. They're gonna push it. But if you just be confident and just you know what, he's gonna explain you the same thing. We do not charge you twice. We can't possibly do that. Software won't let us. Drop me a text and I'll ring her later. Okay, no problem. Okay, cheers. Okay, no problem. Bye. Really sorry, Kumar. It's a new reception.
Oh, right. Okay, no problem. Right. Okay.
Everybody's on. Yes.
Yeah,
Sorry.
this is your case study. You are in something and then you get a problem. You have to solve that problem. This is your case study.
Mm.
On a day-to-day basis, you will find this kind of a thing happening. Some difficult
Yeah.
customer come in and your receptionist cannot handle it, and then they bring it to you. How to handle it? How to motivate the receptionist to do it in the next time without referring to you. So this is your case study. These are all practical aspects which come up. So you know what you have to use is mostly the common sense in this kind of a question.
Mm.
But having said that one, there are a few technical areas which we need to know, because we being SIMA, we are expected to know certain accounting requirements that need to be followed up whenever we take a decision.
Yep.
So we were talking about a company. Company is owned by shareholders. So you can be a shareholder, I can be a shareholder. We are individuals. If you hold a big shareholding in a company, say 50% or plus of the shares of that company, you become the controlling shareholder. But you are an individual. But if a company holds in another company a kind of a 50% plus shareholding, company also has the same legal status just like a person. It is a separate legal entity. As much as the people can take us to courts, they can take the company also to courts. Company also can file action against a person, just like we can file action against a company, against a person.
Separate.
Yeah?
Yeah.
It's what we call separate legal entity. So a company can hold shares in another company, and if that other in that other company, if a particular company is holding more than 50%, generally it is called the parent company, and the company on which you hold shares is called the subsidiary company.
So company who owns the share of another company is the parent company.
Owns more than 50% of your voting rights shares. That company is called the parent company. And the company that is being held is called the subsidiary. So there are two separate legal entities. So we have the company A. The company A. Company A. Now the company A will be owned by many shareholders. Right? So where will be holding shares? Will be holding shares. There will be thousands of people holding shares. But the company A can go and invest in another company.
Yeah.
They will buy shares of that company A, just like any individual can buy shares in company B. Company A also can buy shares in company B. So the company B, let's assume the company B share capital is 100,000 shares. It all depends on the percentage you're holding. If you're holding anything between 1 to 20%, company A holds in company B anything between 1% to 20%, or 0 to 20%, it's called an investment.
Okay.
Investment. So there are 4 kinds of instruments that are coming up. The IAS 39 is the relevant standard. That is if you hold 1 to 20% in company B. If you hold anything between 20 and 49, then the company B is called the associate company. Associate company of company A. What is meant by associate company? You don't have the control, because you can't control the company, but you will have a significant influence. When you hold up 20 to 25%, 30%, your voice will be heard, but you can't take so much of big decisions because the other parties will be holding the control. So this is covered up under IAS 28. And if you are holding anything above 50%, Generally, in that case, the company B is called a subsidiary, and in that case, the company A becomes the parent.
Hmm.
Remember, if you are holding 20 to 49%, the company B will be called associate, but company A is now never the parent. Company A becomes a parent only if you have a subsidiary, and that means you must have a 50%. I will come to that in a minute. It's not the real 50%, but the relevant accounting standard is IFRS. So that is the most important thing. So the key word here in the third step is what we call control. If you hold, generally it is assumed that if you hold anything more than 50% of shares in one particular company, that company you can control, and therefore it becomes the subsidiary, you become the parent.
Yeah.
If you are holding 20 to 40%, you are never a parent, but you will be having an associate company.
Okay. Which one is the third one? Like which instrument would that be?
That is called that is where consolidation comes up. That is what we call the subsidiary parent relationship. Third one.
Which one is IS? Is the instrument number for that? Or
IFRS 10.
it's 10. Okay.
IFRS 10. Earlier one, International Accounting Standard 39, International Accounting Standard 28. This is International Financial Reporting Standard number 10.
Reporting standard. Yeah.
Yeah. IFRS 10. Right.
Yeah.
So the company A will have to prepare its own independent financial statements, forgetting the company B's investment. Just they have to treat it as an investment in their balance sheet and separately prepare the financial statement. Company B will have to prepare its own financial statements because it's a separate legal entity. They must show their profit, they must show their losses and prepare their financial statements. So both the company A and both the
Kumar, can I just hold you for 2 seconds, please? I'm
sure,
just bugging in
sure.
my head.
Yeah.
I need to just.
Okay.
Sorry.
Sure.
I'm trying to make it quick.
Okay.
I was hoping she will not call me within this hour.
Okay.
You were telling me about. I understood this how they they call investment investment is called
When you
associate
have a
company.
1 to 20%, it's basically a kind of a investment, just an investment. You only get the dividends, that's all. You don't have any influence, you don't have any control. Second scenario, you have a 20 to 49%. In that case, you have something called significant influence. In that case, your company, the second company where you own 40% or 49% is called the associate company of yours.
Yep.
Third scenario is the important one, but we are looking at just now, is where you hold more than 50%, and in that case, you become the parent and the other companies becomes the subsidiary.
Yes. You're telling me about the books. So the first company you said
The
you have to
first
do
company, whatever the scenario, the first company will maintain its own set of books. Second company will maintain its own set of books. Right? But when it's a parent and a subsidiary relationship, the parent will have to prepare, in addition to its own accounts, another set of accounts called consolidated accounts.
I see. That's consolidation. Yes.
That is what we call consolidation. So there are certain techniques what need to be applied. That is what we call the consolidation. So remember, consolidation happens when you have a parent and a subsidiary. Parent prepares its own accounts, subsidiary prepares its own accounts, but the parent is required by IFRS 10 to prepare another set of accounts, consolidating both sets together and preparing one set of accounts called consolidated accounts of company A.
That includes its own information and the information of the subsidiary.
Exactly. It's a merge one. It's
Yes. Yeah.
now you and I, we are shareholders of company A. We want to see
Yes.
as the company A has invested in company B and they have a control. We want to see, you and I as shareholders of company A, we want to see the overall picture. And that picture
How
is
is-
given only
how-
by the consolidated statement.
Just to see how is the parent company doing.
Just to see how the parent company is doing in the subsidiary. Just to see whether the investment is good or bad.
I see.
Because you ultimately what may happen is, for example, parent company may make a big profit, 1 lakh on its own, but the subsidiary may end up with a loss of 20,000. I'm making it very simple just to show you the example. When you consolidate, you might see the profit comes down to 80. When you look at the individual, the parent company, oh wow, good, 100,000. But because you had bought a bad subsidiary, and because of the bad subsidiary, now it is coming down to 80. To reflect that your investment, whether the investment is good or bad, it will be shown by the total consolidation, what we call the parent and the subsidiary consolidation. So remember, the consolidation applies, IFRS 10 applies only if you have a parent and a subsidiary, not a parent and an associate, not a pair. In fact, you don't have a parent and an associate. You can only have a parent and a subsidiary. But you might have a situation like this. Company A holds in B parent subsidiary relationship.
So what can happen is you can have a company with 3 or 4 associate companies.
Yeah, that's what I was trying to come up. You can have one company A. Many associates. Still you will not prepare consolidated statements because they are associates. But you might have a scenario, parent having one subsidiary.
It could be XYZ could be 33, 33, 33, and you don't have to make any.
Not necessarily 33, 33, 33. It can be 25.
I know. Just example. Yeah. Just give me an example.
Still you will not consolidate. Still A is not a parent.
Yes.
Still A is not a parent. But in the second scenario,
above 50%, yeah.
Above 50%. But imagine company A holds in company B 50% and company A holds other company called X, they hold 25%. So company A, as far as B is concerned, parent subsidiary, A and X is concerned, it's an associate, but still, because it's a parent and a subsidiary relationship exists, A will have to prepare consolidated accounts.
Even for X as well.
X as well. X is not consolidated. X has a separate way of preparing X being merged.
X is associate, yeah?
X is associate. Associate accounting treatment is different from the consolidated accounting treatment.
No, but what I was asking, what question I was asking, so they don't have to merge X details.
They have to merge X, but in a different way.
Okay, so it's not going to be consolidated.
It will be, the A and B will be consolidated. There will be a preparation for the consolidation, but Exos will be included in a different way for associate company accounting. For example, in the top example, what I said, A has 3 associate companies. It will not be a consolidated statement, but it will have an associate accounting, a separate accounting where they will merge, but in a different way. That's why there are 2 accounting standards, IAS 28 dealing in a separate way, IFRS 10 dealing with a separate way. So we are looking today the parent subsidiary way, how it need to be, parent and a subsidiary, it need to be consolidated, the steps and the principles involved in consolidation. Can be associates, but let's not mix up with the associates for the moment.
Okay.
So as I said, the relevant standard is IFRS 10. So the key word is the control. So I said when you have 50%, it is presumed that there is control. So whenever we have 50%, it is assumed that we have control unless there is some other reason to say that you can't control. In that case, the company A becomes the parent, company B becomes the subsidiary. In that case, the IFRS 10 says consolidated financial statement should be prepared. The control, the term keyword here is the control. I said normally when it is 50%, but the real term for control is where you have the power over the investee. Power. That you have the power. Power means you can remove the directors, you can decide on the dividends, what you are going to pay, you can make your operating and financial decisions because you have the power. Now, if you have 40%, you don't have the power. That's the assumption.
Sorry, I didn't get this one. Net present group will exist in the company. So what does the group mean? What does you're talking about group as?
Yeah,
group
so
and
when the
IFRS,
parent and the subsidiary gets together, it's a group.
it's called a group. Okay.
Parent and subsidiary or parent and subsidiaries, when they are together, it's called a group of companies.
Okay.
One parent, many subsidiaries. One parent, two subsidiaries, one associate. One parent, three subsidiaries, one associate. It's called a group. It's called a group. So wherever there is a group, that means we have to prepare consolidated financial statements. The idea is you must have a parent, you must have a subsidiary, and in that case, the parent must prepare separately a consolidated financial statements when the parent and subsidiary together is called a group of companies. Right.
So investor controls the investee when the
investor is the parent, investee is the subsidiary.
Okay.
Parent
because I got confused.
Yeah.
With the less than 10% is investment, so that's why I got confused. It's not.
But that no. Here there is no 10% less than 20% anything. Here it's basically a parent and a subsidiary means you must be having more than 50%.
The investor is the parent.
Investor is the parent, investee is the subsidiary. Here we are talking all about more than 50% kind of a scenario. The key word is the power. When you have power means when the parent has the power or the investor has the power over the investee, that means it's a subsidiary.
So it has the power to, it is exposed.
The power is to the ability to affect those returns. Returns means they can decide the dividends of the company B.
They can pull the money out whenever they decide.
No, they can't just pull the money out. They have they have to go through the normal company law, legislation, everything. But they can decide the dividend what they are going to pay. The company B's dividend will be decided because the majority directors of company B will be appointed by company A because they are controlling. That is what I mean by control. Your company, if my company is having number of big shares in your hotel company, I will be controlling, my company will be controlling your company. We can decide, our directors can decide who are going to be your directors, who are going to be your CFO, and what kind of a dividend we will declare.
So what does it mean, right to variable returns?
Right to variable returns means the dividends is a variable return.
Oh, so it's talking about the dividends, so they can decide how much.
Yeah, but that's the technical term they use, variable return. They can decide the variable return. If they can't decide, because the preference dividend is not a variable return, preference dividend is a fixed return. Interest is a fixed return. But equity dividend or the ordinary share capital dividend is a variable return. So long as you, the investing company, has the power to decide on the investee company's dividend, that means you are controlling. Right? So right to variable returns from the involved. So you have the right to receive, your directors can decide to pay a 20 cents dividend, they can decide 25 cents dividend, can decide not to pay any dividend at all in the company B.
Yes.
And the power means they can remove the directors, they can put new directors, they can remove the big key people, CFO, CEO, all that, because they have the power. Now, if you are holding 20 to 49%, you don't have that kind of a power. You can influence, you can tell the others, we don't like this director, to remove him, or we don't agree with your dividend policy, but they can't dictate, they can't dominate. Power is defined as the existing right that gives the current ability to direct the relevant activities. What are the relevant activities? Appointment of directors, decision of a dividend, appointment of auditors. The power, you can use the power to do any of those things, to direct the relevant activities.
By existing right that gives the current ability.
Yeah.
Direct the relevant activities.
Relevant activities. That means that we have the power to direct. I mean, basically, in a nutshell, your company can decide, in my company, the financial and operating policies. You are the parent.
You can decide who's going to be the financial director.
You can decide not only the financial director, you can decide on any director.
Also the policies, well, relevant
policies. Yeah, financial and operating policies. Whether we want to have a new IT system, all those decisions can be controlled by the parent company. And in that scenario, in that kind of a parent-subsidiary relationship is there, then the IFRS 10 come into the scene. It becomes a group, and the parent must prepare financial statements in addition to its own statement, a combined statement, what we call consolidated statements, combining all the subsidiaries and all the associate companies. So that is what it happens. Power over the investing, exposure for variable returns, and ability to use its power over the investee to affect the amount of the investor return. So power is the key word, and the control. So when you have that one, parent is parent, subsidiary is the subsidiary. In that case, consolidated prepared should be prepared when the parent has control over one or more subsidiary. So for examination purposes, generally it is assumed if you have more than 50% of voting rights of the other company, then you hold the power. So there are two types of shares in the world. One we call preference shares, the other one what we call equity shares or ordinary shares. Preference shares don't give you the voting rights. Preference shares don't give you the voting rights. Preference shares, you are not entitled for variable returns. You are paid a fixed percentage of a dividend.
What is it called again?
Preference shares.
Preference.
Yeah, PRE, FERE, and CE. Preference shares.
Yeah.
Right? Preference share. You get preference for dividends. If you are invested in preference shares in a company, before the company pays a dividend for the ordinary shareholders, they must pay the preference dividend, but it's a fixed percentage. Fixed percentage. But ordinary dividend is not a fixed percentage. The directors can decide to pay 20 cents per share, 10 cents per share, 0 cents per share, $1 per share, anything. That's what you call it a variable return. So even if you hold 100% of preference shares in company B, still you are not the parent because you don't have the controlling power by holding preference shares in a company. But if you hold anything more than 50% of ordinary shares, then it is assumed that you have the control. And in that case, IFRS 10 applies. The parent must prepare an additional set of financial statements, what we call consolidated financial statements. So, whenever a parent and a subsidiary comes into the scene, the way that we do that accounting is called acquisition accounting. So, parent is holding more than 50% in a subsidiary, then consolidation need to be done. The way of consolidation accounting is called acquisition accounting.
Yeah.
If the company A holds 20% or 25% in another company, which we call associate company, the accounting treatment is called equity accounting. Equity accounting. So in the consolidation, it is called acquisition accounting. There are certain exemptions. We need to know about these things. Now, as I said, the parent, company A, company B, if the company A holds more than 50%, company A must prepare consolidated financial statements. However, there are few exemptions which you need to know because sometimes in the case study they might test you on this kind of a thing, right? Now you might find company B also holding. So company A is holding 60% in company B. Company B is holding in another company called C 70%.
Oh, okay.
I want you to understand. If you look at A and B, A is the parent, B is the subsidiary.
Yep.
If you look at B and C, B is the parent, C is the subsidiary.
Yep.
Right? Now, here we have a middle person. The B is a middle person.
Yes.
In this case, B, now normally if you look at B and C, according to IFRS 10, B must prepare consolidated statements. If you look at A and B, A must prepare consolidated statements. But when A, B, C like this happens, if all the shareholders of B is informed that B is ultimately owned by A, because ultimate parent is the A, in that case, there's an exemption. B don't need to prepare consolidated statement on its own. Listen, A is preparing, consolidating B and C together.
Oh, okay.
Because A is holding directly 60%, by the virtue of the fact A is the grandparent, and because the virtue of the fact the A is controlling B, and because B is controlling C, by the line is A is controlling C also indirectly.
Yep.
A is controlling B, B is controlling C. If you really look at A is controlling C indirectly. And because of that one, A has to prepare consolidating B and C together, and therefore B don't need to consolidate.
A question here.
Yeah.
What about the power? What about the voting rights? What about the control?
Yeah, because now you can see A has the power over B.
No, I'm talking about A's power over C.
Yeah, because that's what I'm trying to say. A has the power over B. B has the power over C. So, because of that, indirectly A has the power over C. I'm controlling you, you are controlling some other person. Indirectly, I'm controlling that other person also.
It's like if you're good friends with your friend's wife,
Yeah.
and you get anything done because you're good friends with her, she will make you do anything.
Yeah, right. Something like that. Yeah, because indirectly you are controlling. Indirectly, indirect. That's a good way to think about it, right? Bad way to do, but good way to think about it. That's the exact thing what's happening. A is controlling B. A has the controlling power over B. B has the controlling power over C. And thereby, virtue of the fact B is controlling C, A is controlling B, A controls C also. So this is what we call indirect control. In that case, the only thing is B don't need to prepare consolidated statements because A is preparing consolidating B and C. If A was not there, B has to prepare consolidated statements. So if the ultimate parent in this case is A. If the ultimate parent is preparing consolidated financial statements, B is exempted from preparation of the financial statements because B is under control of A. Of course, still, if you look at the line number 1, 2, second line, its debt or equity instruments are not traded in a public market. Now, if B is a listed company, where its shares are traded on the public market stock exchange, this exemption will not apply. B will have to prepare its own consolidated statements. A will have to prepare its own consolidated statements.
Well, even then, whenever A makes his own statement, you will still have to include the C?
You have to include the C. A will have to always include C, but B also will have to prepare a separate consolidated statements, including only C.
Only C, yes.
Only
yes,
C,
yes.
right? Because in that case, A won't come into the C as far as B is concerned. But A will have to prepare both, including B and C together.
So if public market means if it's listed, yeah?
If it is listed. If it is listed.
So there are different words.
Yeah. Yeah, because these are the words that they have been using. So we have to be very, very careful because when they say not traded in the public market, that means not listed in the stock market.
I see. Yes, yes, yes.
So you have to be very careful because some of the terminology what we use in the common language may not be what they use in the real technical language. So
I'd rather you use as much as you can, whatever they're supposed to use it, so I learn as much as, you know.
Exactly, you're right. These are a little bit of exemptions because sometimes they might put up a question and say whether we should consolidate or not. Then we have to look at whether it is exempted or not, that kind of a scenario. So
all this I've studied, and now that obviously you're such a good teacher as well. You know how you start, but it's all coming back to me, to be honest.
Yeah. Now I think what you must do is after this you must go through the past cards and try to pick up, not do the revision so that it will come to your head again. So what is this acquisition accounting? Acquisition account is where we bring the parent and the subsidiary together and prepare one set of accounts where we combine the assets, combine the liabilities, combine the revenue, combine the profits. We add everything together. That is what we call acquisition accounting. So, say example, parent has 100 million property, plant and equipment. Subsidiary has 20 million property, plant and equipment. The total property, plant and equipment in the consolidated statement will be 100 plus 20, 120.
No, I didn't get this.
No, what I said was, when we say acquisition accounting, we just go and add all the assets and liabilities.
Yes,
Parent
yes.
has
Yes.
property, plant and equipment 100 million. Subsidiary.
Sorry, I lost voice. Yeah.
Subsidiary has property, plant and equipment 20 million. So under acquisition accounting, both these things will be added up and prepare. When you are preparing the consolidated financial statements, in the consolidated statements, the property, plant and equipment will appear at 120.
Property, sorry?
Property, plant and equipment. Any assets for that matter.
Okay. Okay. Yes. 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 Yes.
Any assets. So the current assets may be 70 of the parent, 30 of the subsidiary, and both.
Mm.
Then if you take the share capital, parent may be 200 million, subsidiary may be 70 million. Now here you don't add both together. Only the parent company share capital will come. That's an exception. You don't add the share capital of the parent and the subsidiary. You have to add only the parent company share capital.
Mm.
So these are what we learned in acquisition accounting. This is the way we do the consolidation. Then if you look at the other things like non-current liabilities, and both. Current liabilities.
Sorry, Kumar, you're breaking up when you're writing. I can't.
That's what when I'm writing, I don't shout. I just write it to explain, and then I will explain it.
Okay. Yes, that's fine. That's fine.
Yeah.
Yeah.
So what I said was, whenever we are doing the acquisition accounting, both the subsidiary and the parent assets are added up, liabilities are added up, share capital we don't add, we only take the parent company share capital.
Mm. So everything as current liabilities,
Current
assets, liabilities.
assets, liabilities all gets added up, except the parent company. The share capital of the subsidiary is never added up.
Is the only the parent company's
share capital
is added up.
Only the parent company, because you are looking from the parent company's point of view, and therefore only the parent company share capital is added up.
Mm.
Shown, that's all.
Mm.
Now, if you really look at the company, look at the company B for example here. Right? Company B for example, they are, let's assume their assets are million. Or let's make it not 20, let's make it 60. Plant and equipment. Current assets are 30 million. This is what we call total assets. Total assets. The non-current assets and the current assets total is 90 million. Let's assume they have liabilities, both current liabilities and non-current liabilities. $40 million. Now what is the worth of the company?
50 million.
50 million. Total assets minus total liabilities. What is that one? Total assets minus total liabilities belongs to whom?
The company.
Yeah, the company means to whom the total assets minus total liabilities belongs to.
This is the B company, isn't it? We're talking
Company
about.
B. I'm talking about company B. Company B.
It belongs to company. Belongs to company.
Yeah, belongs to
company A.
Yeah, belongs to company A, provided they have entire 100% holding. But sometimes they might not have the entire 100%. They might have only 70%. Still they control. Right? Yes. So the 50 million is the share capital and reserves of company B. 90 million is the total assets. Total assets. Total liabilities are 40 million. That means the balance is share capital plus reserves, because you remember share capital plus reserves plus liabilities equals total assets.
Yes.
Share capital plus liabilities equals total assets. Share capital plus reserves.
Yeah. Capital
Plus reserves
plus.
plus liabilities equals total assets. That is what the statement of financial position is.
Yeah.
Right? So total assets minus liabilities is share capital plus reserves, and that is what you told me. That is the value of the company. Total assets minus liabilities is the value of the company. That value is represented by share capital plus reserves.
What's reserves?
Reserves means your undeclared profit, any other reserve, revaluation reserves, whatever that belongs to the shareholders. When the company makes a profit of 100 million, they might pay 30 million dividend, keep the 70 million, that is a reserve. So you invest in the company in the share capital, your share capital grows up with the reserves. Anything that is not declared as a dividend is inside the company which belongs to you. That's how the companies grow.
Yeah.
They make 100 million profit, they pay you 30 million dividend, but they keep the 70 million. So that's your reserve. That's your reserve. So the total company wealth is share capital plus reserves.
Yeah.
In other words, that is total assets minus total liability. So this is what we call net assets.
Yeah.
Now assume today you want to buy this company. Let's assume this company subsidiary is, you want to buy it, and the net assets figure is 50 million. Into the balance sheet 50. Let's assume we are going to buy 100% of that company. The value of the company according to the books, according to the assets is 50 million. Now when you want to buy it, you may not be able to buy it for 50 million because they might ask for a higher price. They might ask for a higher price. Although the value is 50 million according to the books, because you will realize in your company, the book values are not the real true values, isn't it?
Never.
Never. Because we are providing depreciation, all that, but your hotel must be having a big value. The buildings will have a big value, but it may not be reflected in the balance sheet at that value. But that figure is 50 million. But your shareholders of company B might say, hey Sohaib, if your company wants to buy, company B wants to buy our company, we need 70 million. 50 is the value, but they ask 70 million. And that 70 million is what we call consideration. Consideration. So you have to pay 70 million to buy a company worth 50 million. So you are paying 20 million extra. Why are you paying 20 million extra?
Because of goodwill?
Yeah, yes, goodwill. That is what we call goodwill. Why are we paying that one? Because there is something called goodwill, something intangible.
Yes. Intangible. Yes.
Intangible, because it is not reflected in your books, but it has a value.
But it has a value. Established business.
Established business. Now, if you are going to sell your business tomorrow, right, your bosses are not going to sell it at your statement of financial position value, because it has such a big clientele, your groups, all those people. Therefore, you will fetch a price higher than your book value. So if I had to pay, I have to pay you more than that 50 million. And that extra amount that I'm going to pay is called the goodwill. So when you combine the two companies, you're combining assets worth 50 million, but you have paid 70 million. So that extra amount what you pay is shown as a goodwill, and that is what we call in IFRS 3. The accounting standard is IFRS 3, which is the difference between the
net value and
between the net value and the consideration is called the goodwill. Sometimes, that is if you are taking 100% ownership.
Say again?
You are taking 100% ownership of a company, 90 minus
Yeah.
40, 50, you are going to pay 70, and that is called the goodwill.
I didn't get that. Sorry, say that again. I was just writing notes.
90 minus 40 is what you are paying. 90 minus 40 is the value of the company, 50 million. You are paying 70 million and you are taking the 100% ownership of the company, and that's what we
Yes.
call the goodwill.
Mm.
Now, assume it's the same example. Minus 40 is 50. This is what is represented by share capital plus reserves, 50. And you are not going to buy 100% of this company. You are going to buy only 70% of this company.
Mm.
You are going to pay, let's assume you are going to pay 60 million.
Mm.
Now, what is the value of the company? 50 million. Out of 50 million, what is 70%? Because you are going to buy only 70%. So 50 million, 70% means 35 million.
35 million.
35 million. How much are you paying? 60 million.
Mm. 25 million is goodwill.
25 million is goodwill. Because there you have to apply the proportion, because you are not taking the entire company, you are taking only 70% of the value of the company.
Mm.
Now, who owns the balance 30%? Who owns the balance 30? Who owns the balance 30%? You are going to buy 70%. Who owns the balance 30% of company B?
It could be associate. It could be associate members, investors.
No, it can be many others. Yeah, it can
Many
be.
others. Yeah.
It can be many
It could be
individuals.
two investments. Yeah.
Yeah, small holders. There may be many others. You have a 70% control over this company.
So we could still have could have one associate and many small investors, or it could have many small investments
Yeah,
into
because
one person.
as far as you are concerned, it's not an associate. As far as
No.
you are concerned, your company A, you have a subsidiary called company B, where you hold 70%.
No, I'm saying the rest of the 30%. If somebody owns anything up to 20, or no, anything up to, for example, oh yeah, it can't be because you're 70%, so it can't be.
Yeah, because it has nothing to do with you unless there's some other company holding 30%. For that company, it will be an associate.
Yeah. Anything. So if there is a company for 21%, that would be associate, and then the 9% could be just investment. It is a possibility, but you
Yeah.
are the parent anyway.
You're not yeah, because we are not bothered about who are the other people. From our point of view, all the other people, they don't have a control and they are called non-controlling
Non-controlling
interest.
interest. They are there to just make money of their investment.
Yeah, they will get the dividends or whatever. You will also get a dividend. But when we are consolidated, now you have to remember, we consolidated both all the assets of the parent and the subsidiary. But we have to remember, even though we take the 20 million assets of the subsidiary and say in our consolidated balance sheet 120 million, we don't own that entire 20 million. We own only 35% of the 20 million, 70% of the 20 million, correct?
Yep.
So, because we are consolidated and showing 100 plus 20, 120, we must show on the other side of the balance sheet as a kind of a liability, but their own share, the outsider's share, what we call the non-controlling interest. Because you are holding only, if in the early example you were holding 100%, in that case we call it a fully owned subsidiary. Fully owned subsidiary. 100% we are controlling. In the second scenario, we don't have a fully owned, we control with a 70%, but there are 30% outsiders whom we consider them as non-controlling interest. Long time back, they were called minority interest, but now they don't use the term minority interest. They use the term non-controlling interest. So we have 60, the 70% is with us, 30% with the outsiders, and they will call it non-controlling interest. So when we recognize our total assets, we must show that there is, although we have recognized the entire 20 million, there is some portion that belongs to the outsiders, and that must be reflected in our balance sheet as a non-controlling interest. So we have to work out a little calculation and show that as a non-controlling interest. So when we are doing some numbers, we will do it. But actually, for the case study, we don't need the numbers. We need to know the principle behind what is a goodwill, what is a non-controlling interest. Goodwill is the excess what you pay over and above the net assets valuation.
Say again?
The excess consideration what we pay over and above the non-controlling, over and above the net assets. That is goodwill. The excess consideration. Excess consideration you pay over and above net assets, our share, the company share, is what we call the goodwill.
Goodwill, yes. I'm with you.
Right.
So net value minus consideration is your goodwill, basically.
Consideration minus net assets. Net assets, our share. Consideration is
sorry?
Yeah. Consideration is 100 million, net assets are 50 million. 50 million, our share 75%, 70%. 50 million, 70% is 35. Consideration we paid is 100 million. The difference is goodwill.
Yeah.
Consideration minus net assets, our share, is what we call the goodwill. So goodwill essentially is a intangible asset. It doesn't have a tangibility, and therefore IFRS 3, the standard is business combinations. IFRS 3, the moment you combine two businesses, a parent and a subsidiary, you might have a goodwill arising. And that goodwill is an intangible asset. It must appear in the consolidated financial statements, but every year it must be reviewed to see whether it has the same value. Now you paid 50 million was the asset value. Let's assume it's a 100% owned subsidiary. You paid 70 million. So what is your goodwill? 20 million. Right? Now you have to check it every year and see whether that 20 million still exists. Why did you pay 20 million extra? Because you thought there's something intangible. Every year you must review it and see whether that 20 million is there or not. It may go up. It may go up. Next year it may go up to 25. But you can't increase the goodwill to 25.
Sorry?
You can't increase the goodwill to 25. If you paid 20, if you have bought it for 20, you can never increase the goodwill. Next year,
you can't increase it yourself.
You can't.
Until you're selling it.
When you sell, the goodwill will be sold. Yes. Yeah. But during.
Yeah, but then you can, if you've bought a business and you've improved, you've made.
No, then still you can't increase the goodwill, whatever the reason.
So who will increase it?
You can't. No one can.
So who decides the goodwill? How much is it going to be?
You have to make a professional judgment. The board of directors will have to make a professional judgment and see if the goodwill has increased. You bought it for 25, it has gone up to 25, 20, you bought it for
Because
25.
if you increase the worth of the shares, the dividends, like you made money, the profits are high, and you can see the profits going up regularly
All
after 4
that is
years.
good, all that is good, but there is something in accountancy what we call prudency. We can't increase the intangible asset over and above the price what we bought initially.
Okay.
Yeah, that's a rule. That is because of the
But
accountant.
but automatically they will increase when the board of directors evaluate before they sell the company. If 4 years later, 5 years later, I decide to sell.
If they sell it, then they will make a profit out of it. But they have to show it as the original acquisition cost all the time till they sell it.
Yeah. No, what I'm saying is that because you paid 20 million to goodwill to buy this company, and this company's doubled its size in 5 years, you made that
Still
much
the
profit.
goodwill is 20 million.
Yeah, but then when a new company buy your company, you
So
sell your
later on,
company.
one day when you sell that company, you might make a profit. But till you make that profit, you can't consider unrealized profit and bring
So
it into your books.
no, but how do you make profit? Because they will say, okay, you paid 20 million 5 years ago, we are paying you the same.
No. You are not going to, the business is not going to happen like that. You bought it with a goodwill of 20 million. When you want to sell it, it will be 100 million. You will sell it at 100. Business is not
So
going to, business is not going to sell.
yeah,
You
yeah,
bought
that's what I was going to say. So we don't have to sell it at the same price, but all you're saying is you can't increase the value yourself. But when the time is there
when
and
it
you
is
have
sold, you can. When it is sold, you can. But till it is sold, you can't.
yes, yes. So if you're keeping it 5 years, you can't change the value in the
No,
books.
you can't.
But 5 years,
But
you decide to sell it,
yeah,
then
but
your
if
board of
it
directors.
comes down,
Yes,
if it
yes.
comes down, it has to be written off. You
Wow.
can't
Okay.
increase, but if it comes down when the board of directors value, it might say we paid 20 million, but now, company is not doing well. The value should come down to 10 million. 10 million must be written off
Wow. In the books.
in the books. Straight away in the parent company books, 10 million must be written off. You can't take credit for any unrealized gains, but any anticipated loss must be completely written off then and there. That's what the accountancy prudency means. So you have to remove the thing, and that is what we call impairment. As I said, the share capital of the group is only the share capital of the parent company. All the other assets and liabilities you will add both the parent and the subsidiary, but the share capital, only the parent company share capital will be shown. Any intercompany balances should be completely eliminated because you are going to consolidate. So for example, you have sold me goods and I have not paid you. In your balance sheet, you will show it as a receivable. In my balance sheet, I will show it as a payable. So when we consolidate, we must remove both the receivables and payables because we can't duplicate it. We can't show it as one side receivables and one side payables because it must get cancelled off. Right? So that also need to be done. Then always, this is a very important one, the last one for case study purposes. Whenever we are consolidating, we must use the same accounting policies for both the parent and the subsidiary. So actually in the F2 paper, you have a lot of calculations, but in the case study, you don't have calculations. But these technical things are very important. Whenever we are say your boss might ask, hey Zoeb, we are going to buy this film company, how are we going to consolidate? So you have to mention these things, that if they are not adopting IFRSs, because remember we are a company, we are adopting IFRSs. First of all, we must prepare that subsidiary company financial statements in line with IFRSs. Then only we can consolidate. Right? So these are the questions that they may come up, because they might say that we want to buy another film company, which is they are not adopting IFRSs. So we can't consolidate. First of all, we must bring that into our uniform accounting policy, and then only we can adopt it. So the net non-controlling interest is the outsider's interest that must be shown separately, because we have only 70%. The 30% outsiders must be shown separately under the share capital as a separate item. So those are calculations what we have to do, but actually in this case study we don't need to do the calculations, but we need to know how these things to be presented in the financial statements. So later on we have to look at the profit and distribute the profit also, because we are going to combine both the company, the parent and the subsidiary, but we have to show the profit separately for the parent, separately for the non-controlling interest. So we will look at some of these things. I think we are meeting again Friday, Saturday, 4 o'clock.
Yes.
Yeah. So Saturday we will look at more of these. I'm going to send you these slides for you. I want you to go through these slides if possible tomorrow, and so that we can, is very.
You send me the passcard. You send me the passcard in the beginning, didn't you?
Yeah, I send you all that.
Yeah, I'll try and find out consolidation and acquisition account.
Go through all the consolidation notes and see, because this is very important, because any question on the F2 area on the case study will be on the consolidation and the ratios.
I think I'm more scared to pass P2 than this case study now, because there's going to be so much numbers.
Yeah, because the case study is comparatively easy, but the theory subjects are tough. So you have to have the theory knowledge to go to these areas.
Yeah, you have to do them one by one, or I mean, you have to do P1 first and then P2, or can you do P2 first?
No, you can do it, because now you can do P1, P2 together almost, because they are built up pillars. So the P1 to P2 is the advanced version of P1. F1 to F2 is the advanced version of F1.
Sorry, the next stage is the, what is it called? P1. Sorry, I meant the P3. P3 and F3.
Yeah.
Do you take them first one by one, or can you take them together?
You can, but I think it's good to do one by one, because it's too heavy.
Sorry, what I meant was which one to do first, F3 first or P3 first? That's what I meant.
No, it all depends. It depends on what you decide. There are no. Some people are very strong on P3. Some people are very strong. Huh?
They don't have to do P first and F after.
You can do it any sequence. No problem at all.
I would probably take 3 months each exam, but it's all computerized anyway. Just take 2-3 months.
60 questions. So E3, P3, F3. Some people they do E3 and finish it off. Some people do P3. There's no sequence. You can do it anyway.
Best thing, take your time and
because you have to do a lot of calculations on that area. So we will see you on Saturday and continue with the consolidation before we move into the question.
I'm off Saturday morning, so I will go through the notes.
Sure. Right, yeah. Okay, then I'll see you on Saturday.
Thanks very much. Thank you for your time.
Thank you. Take care.
Thank you, and you. Bye-bye.
Bye.